Well, the one big, beautiful bill is now the law of the land. And so over the past couple of weeks, we've had the opportunity to kind of parse through the 900 pages that is the bill. If you're wondering if that actually is the real legislative name of it, yes, it is. It is called the One Big Beautiful Bill. I guess many folks are using the abbreviation BBB. I'm not sure the Better Business Bureau is a fan of it, but be that as it may, we're going to talk about some of the major tax implications that you need to know and how to plan for the road ahead with this massive piece of tax legislation. Plus, we're also going to be talking about the 10 ways to fail at retirement. Now, these are some of the hazards to your money, your health, your happiness that can occur when you step away from work. The top 10 list was actually highlighted in an article, a recent AARP article that we came across that we are posting on our various social media platforms. You can read the whole list. Obviously, if it's a list of 10 things, that's a little hard to squeeze into a 40-minute radio program. So we're going to hit the highlights on that here on this week's episode of Dollars and Cents, where we help you make sense of all of life decisions involving your dollars. One of Central Florida's longest running radio programs, also coming to you on a host of podcast platforms as well. Check us out on your favorite media of choice, or if you have trouble finding our channel, go to our website at nelsonfinancialplanning.com. There you'll see a bunch of icons. Click on the one that looks most familiar, and that will automatically redirect you over to said channel. Once you're there, you know what to do. Hit that subscribe button and make sure you're smashing that like button as well when you listen to the programs. That all helps, the AI behind all of that stuff. Anyway, my name is Joel Garris, not computer generated, not AI based, at least not yet. And who I am with Monday through Friday, Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary there. You have the opportunity to hear a lot of folks here on the program that are also part of the team at Nelson Financial Planning. They all happen to be certified financial fiduciaries and stand ready to help you improve your life with a cost-effective and successful financial plan, maybe even one that kind of takes into account all of these big tax changes. So here we are. Original air date of this program is July the 20th. By now, you should have received your statement or your investment account statements for the second quarter of the year. And you might be surprised by what's in it. This one is one that you want to actually open because it does have a good result. And the interesting thing, though, that kind of, I guess, accelerated the results of what you're going to see on that second quarter statement is simply just kind of the timing, right? So the second quarter statement would be from April 1 to June 30th. That coincides with sort of the bit of the low in the markets that happened around the first part of April, when most of the tariff conversation was at sort of full volume. And then, lo and behold, all of that stuff wound up getting suspended for 90 days, which then sort of explains why we're seeing that tariff conversation start to gear itself up yet again in the headlines and the markets. But the second quarter really did overlay that market recovery from those headlines shifting. And to put that into perspective on a historical basis, the second quarter of 2025 was the first time since the first quarter of 1938, so that's 87 years ago, that both the S&P 500 was both up and down at least 10% in a single 3-month period of time. Isn't that kind of an interesting statistic? 87 odd years to see that phenomenon again happen. This just underscores the volume of volatility, particularly what we just came through in the second quarter of this year. In the quarter that was, the tech stuff, the growth stuff, actually contributed a lot of that recovery, much more than the value or sort of dividend side of things. If you look at the S&P 500 growth index, that gained nearly 19% in the second quarter versus a gain of just 2.5% for the S&P value index. So that gap in performance, that 16.3 percentage points of outperformance of growth versus value, was the widest of any quarter since 1995. So the second quarter of this year, the one that is represented on those statements that you got in the mail this past week, or maybe these past couple of weeks, really does represent a pretty unique quarter in the grand scheme of things. The average U.S. stock fund posted a total return of up about 10% for that 3-month period just ended. A nice recovery for those pure domestic U.S. stock funds since they're experienced an average decline of about 5% in the first quarter. That puts the year-to-date results at about 4% for that typical U.S. domestic stock fund. Meanwhile, if your portfolio holds international, which, by the way, it should, because that's part of a well-diversified portfolio anyway, international funds were up about 12% for the quarter. And since they did actually pretty well in the first quarter of the year, so far in the year so far for the first 6 months, up on average about 19%. So again, highlighting the reason to be diversified. And then, of course, staying on that diversified portfolio theme, bond funds, which obviously is your more conservative element of your portfolio, posted about a gain of about 1% for the quarter, right? So that's understandable, right? Lower volatility, lower return on that type of asset class. But for the year so far, bonds are up about 4%. And so what's interesting about that is that this is a rare year with all of the other kind of rare historical statistics we've been giving here in the first part of this first segment of the show. It's when you look at stocks, which measured by the S&P 500, and bonds measured by the Bloomberg Aggregate Bond Index, both of them gained about 4% in the first 6 months of the year. That marked actually only the fourth time since 1990 that both stocks and bonds had that strong of incredibly similar performance for the first half of the year. Good news is that in all four of those other times, both the markets, the stock market and the bond market, continued on with that trend. So perhaps a good sign for the road ahead here for the rest of 2025. Obviously, some funds, particularly sector ones, did better than others, and a diversified portfolio that has bonds would not reflect the performance of the overall stock market. But clearly, as an investor, you have to be feeling better as you're looking at that second quarter statement in the mail that you probably got this past week or maybe the prior week. So certainly better than the one you would have gotten in April that represented that first quarter. And I think, when you think about those historical statistics, something that the volatility that happened in the S&P 500, not seen since 1938 for the second quarter of this year, just another reminder of the importance of being consistent, because you might have missed that big swing if you overreacted with your stock funds to the headlines that were afloat at the end of March. So just another reminder of some of those fundamentals of investing. Now, in other headlines this past week, latest inflation report came out, increase up to 2.7% from May's 2.4%. That increase was somewhat expected, obviously, as some of the conversation about tariffs and things like that sort of make its way into the pricing of goods and products and services. But the greater issue that then sort of creates is whether the Fed is now moved to cut rates. Now, That is stimulus in theory for the economy, cheaper money, all of that good stuff. But it will not be a good thing for your money market savings. And that last check was about $7 trillion in there. Why do we say that? Well, it's an easy decision when money markets are paying 5%, which was the story a year ago. Now they're down to 4, probably under 4. If by the end of the year they're under 3 in the 2s, you start to lose to inflation by sitting in cash. So you're going to have to kind of maybe think about something different on that. We'll have some more thoughts on that later on in the program. But we're going to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. One big, beautiful bill, and that is, in fact, its official legislative name. Now, the law of the land. What's in it for you? What's the impact on your money? It certainly covers a lot of things, right? It's 900 pages, so a lot of stuff in there. At its core, though, the primary purpose is to retain the lower income tax rates that were incorporated in the 2017 tax bill. Okay? Remember, all of those tax rates in that 2017 tax bill were set to expire at the end of the year. So unless the current administration and current Congress did something, such as this bill, they would have effectively presided over what would have been perhaps one of the largest tax increases in decades had this bill not gotten done. But it did get done, and it certainly did have a lot in there. But we want to caution you a little bit as we continue our analysis of this bill. The vast majority of this piece of legislation, and certainly the cost and certainly the impact, is to really continue current policy. Okay? Now, a bunch of headlines getting talked about this conversation about reducing tax on Social Security, no tax on overtime, being able to write off car interest, stuff like that. But that's kind of marginal stuff when you really actually kind of look at it. It's not an excessively meaningful or an excessive economic impact. The real economic impact was continuing that 2017 tax rates so that there wouldn't be a negative economic impact had all of those rates gone up pretty dramatically. And that's the real, that's at the end of the day, that's the real impact of this bill, is to prevent that potential economic drag. I mean, that's where a lot of the focus and a lot of the costs of this bill was. So at the end of the day, because of it, it really did have limited ability to introduce incredibly broad and newer tax cuts along the way. So its impact, in our view, somewhat limited in terms of its ability to accelerate things economically. Yes, it certainly prevented things from potentially slowing down economically by making permanent the tax rates, but there's not necessarily anything new. I mean, basically, these are the tax rates that you've had since 2018. They're just continuing them and effectively making it permanent. So the rates of 10, 12, 22, 24, 32, 35, 37% income tax rates that were set now stand, and they stand permanently. And obviously that's significant when you think about the 12% used to be 15, the 22 used to be 25. And now these rates don't have a sunset. They are, in fact, permanent, which, I guess as permanent as things can be in Washington, right? The reality is that if they do change in the future, then the political party that does change them will, in fact, be tagged with raising taxes. Now, but we've certainly seen history where tax rates have kind of ebbed and flowed. Right now, they're obviously ebbed at a very, very low point, which, I guess explains why the deficit is at a really, really high point. That's probably an issue for another day. Clearly, it didn't seem to really bother a lot of people in Washington, so we will carry on in that respect. Clearly, the lower tax rates are a major impact on your finances, but the point is that since these are the same rates that you've been experiencing for the past several years, then the impact or the immediate impact or the change in your personal finances is not that material. Now, it clearly presents some opportunities of things like accelerating income in the current or next few years, because while permanent, all it takes is legislative change to change these tax rates. So things like distribution of inherited retirement accounts or maybe Roth conversions might be more in the mix, as they have been for the past few years as a result of kind of these lower tax rates. The range of income for a married couple that gets you 24% is from about $100,000 to $400,000 of total income. So it's a pretty wide range. Beyond the tax rates that were made permanent and continued, what also was retained was a shift away from itemized deductions, this courtesy of the nearly doubling of the standard deduction and the elimination of personal exemptions. If you think back prior to 2018, there was personal exemptions and standard deductions, all of those combined in together to create a deduction that you could take off of your income. With the elimination of personal exemptions and a much higher standard deduction, then that is what most people find themselves taking advantage of when it comes to their taxes. So in particular, a bunch of the itemized deductions, such as unreimbursed employee expenses, casualty losses, those kinds of things, it's now permanent that they are permanently eliminated from the ability to itemize and write those specific items off. So what it basically means is that the return of itemizing your deductions certainly is not returning anytime soon. And now with the much larger standard deduction, that basically is the threshold, right? Here's how it works. You either itemize your deduction or you take the baseline amount, which is the standard deduction. If the standard deduction is so high, then fewer and fewer people are winding up itemizing out their deductions. More and more just kind of stake the standard amount because it's a much higher number. And the stats bear that out. Prior to these tax changes, something like a third of all taxpayers were itemizing their deductions. Now it is less than 10%. So you can see where that made a big difference. So the standard deduction for the year 2025 is going to be $15,750 for individuals, $31,500 for couples, and obviously will rise with inflation after that. As we said, the personal exemption of various miscellaneous itemized deductions remain gone. Now, beyond that, beyond the tax rates, beyond the standard deduction, the bill also makes permanent the increase of the $2,000 tax credit. Previously, that was $1,000. Now it's locked in at $2,000. Here, the new bill actually does do a little bit of a change because now that child tax credit is going to be automatically indexed for inflation, and the new base amount is $2,200, not $2,000. So extra $200 right there out of the gate. That's new, but it's $200, so it's not exactly going to be a big difference in people's pocketbook. As for the estate taxes, the new bill adds some clarity here, again preventing what would be a major shift if nothing was done. Remember, estate tax exemption, that's the amount that you can pass, whether you're living or whether you die, to other people and not have to worry about paying any kind of estate taxes. When I started out in this business, that number was $600,000. So really, really low, or really just an indication of how long I've been doing this. In contrast, for the current year, 2025, the exemption increased to about $14 million per person. But again, and you should be hearing a theme here, lots of things expiring at the end of the year, which obviously this bill addressed. That 14 million number would have dropped down to 7 million per person in 2026. The reality is that the new legislation sets the amount at a permanent number of 15 million per person starting in 2026, and then regular inflation adjustments after that. So other changes more or less maintain the status quo. The alternative minimum tax doesn't revert back. It stays where it is. The 20% qualified business income deduction for pass-through still exists. Again, those were set to expire Guess what? They're not. But there are some things where were some little bit of tweaks, a little bit of changes. So we're going to have some additional thoughts on this after the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, helping to make sense out of one big, beautiful bill in this episode of Dollars and Cents. As we were talking about just prior to the break, a lot of the changes really aren't changes. A lot of the changes per se involve making permanent the changes that were done in that 2017 tax legislation. So effectively what that means, folks, is that you're not really going to see a whole big change on your tax return. The point is that your tax return will continue on as it was, because now those lower income tax rates are permanent. The higher standard deduction also permanent. Less and less people are going to wind up itemizing because that standard deduction is quite as high as it is. Things like your state tax exemption wound up sort of getting addressed with a little bit of a higher number rather than a dramatic drop. Other things like the 20% qualified business income deduction still stays. Alternative minimum tax thresholds stay basically where they have been for the past few years. Ability to deduct moving expenses remains gone. Ability to deduct some of the unreimbursed employee expenses, some of those miscellaneous itemized deductions, that remains gone and is now gone effectively permanently. Mortgage interest deduction limited to only $750,000 of mortgage debt. So that's an important threshold. I guess I would argue if you've got more than $750,000 of mortgage debt, be careful. That seems like a lot of debt, in my opinion. Other areas where the bill continues, or I guess continues the current tax landscape without a whole lot of change, is some of the provisions on investment taxes and retirement savings. The top tax rate on long-term cap gains remains at 20% plus a 3.8% surtax. That is the top rate. North of $500,000 of income or thereabouts will get you into that. Contribution levels and rules for traditional or Roth IRAs and 401ks remain the same. So that's a bit of an overview, if you will, on what didn't change, or I guess what would have changed had this bill not passed. Now, there are a variety of things, and we are going to kind of put those into the less dramatic category, but they are certainly important. Things like a change in the ability to deduct state and local property taxes. That's known as the SALT deduction. There's also some interesting broader options in terms of deducting charitable contributions. And then, of course, provisions that relate to reducing tax on Social Security. By the way, it didn't actually address the tax itself on Social Security. It addressed it by increasing or giving an additional amount for that standard deduction amount. There are also some provisions that had to deal with tax on tips, tax on overtime, car interest loan deductions. Look, those topics are really specific. They have very specific guidelines, very specific phase outs, very specific ways in which you might be able to use that. And at the end of the day, that's a whole nother radio show. So stay tuned for next week. Zach and Christina will be on the program, and they're going to tackle these various highly specific new changes in the tax code. Bottom line, this thing was 900 pages, and vast majority of it dealt with really continuing on the major tax provisions from the 2017 tax bill. But next week on the program, Zach and Christina, two of our certified financial fiduciaries at Nelson Financial Planning, will be hosting, and they're going to kind of really get into the nuances of these things that you've really probably been hearing a lot about this bill, but at the end of the day are not as seismic of movement in terms of the ultimate impact that it's going to have on your taxes. But we're going to let them talk about that in much more detail, because this one really does have a lot going on. So with that, we're going to shift gears and start to talk about this AARP article that we mentioned at the top of the program that highlighted the 10 ways to fail at retirement. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we help people every day of the week retire and address these concerns that we're going to talk about in this particular segment of the program. So to ask for one of our absolutely free, no obligation conversations, just go to our website at nelsonfinancialplanning.com. There you fill out the Contact Us button, and we'll be happy to set you up with an appointment, or you can call our office. We actually have live human beings that answer the phone. Isn't that novel? 407-629-6477 is that number. So this article that we're going to tackle comes to us courtesy of written by Bruce Horowitz of AARP. We put it up on our various social channels and whatnot, so you can see the full top 10 list. It's got a lot of information in it, so hard to cover it in just a single radio show. But the point is that perhaps maybe a little bit of negative reinforcement about the things that people don't do before or perhaps during retiring might, encourage folks to think about it and try and avoid it, and give them ways in which that they can hopefully improve their physical, mental, and emotional well-being. So we're going to dig into a few of them on the top 10 list that was part of this article. Try to sort of pick the most impactful, if you will, for you to consider. The first, and this one you hear an awful lot about when you're thinking about retirement, make sure you kind of plan to be sticking around for a while. Longevity being what it is, the reality is that if you're 65 years of age today and a female, chances are on average you still have a life expectancy of another 20 years. Men, sorry, it's a little less than that, but still pretty good at 17 years. So that's if you're age 65 today. So that's a good long time that you need to make sure that your investments, your retirement continues to be on the same path as what it was when you started out. So another statistic, U.S. Census Bureau estimates that the centurion population, so that's people above 100, will quadruple. So there's going to be 4x more of them by the year 2054. So a long time. That's probably one of the biggest issues when it comes to the risks or the ways in which people can fail at retirement. Clearly, your investment allocation needs to have some growth, probably a greater amount of growth than you might very well have planned for, and certainly much more than sort of the target date funds, the online calculators, and all of that would suggest. I think that ties in directly with the comment at the beginning of the program about inflation and where interest rates may be heading and the impact that's going to have on money market rates. If you're one of those people that's been sitting comfortably in a money market, particularly when they were making around 5%, well, that's great, but they ain't making 5% anymore. Now it's less than 4%, and if you get a couple of rate cuts, particularly in light of the uptick in inflation data that came out this past week, then guess what? You're probably going to be in the 2s by the end of the year. That means that you're basically losing to inflation, so you got to figure out another option, another path. Had a bunch of conversations with folks just this past week, kind of really thinking ahead of what that might look like. And one of them had 1.3 million sitting in money market. Another one had 800,000 sitting in money market. And starting to kind of see those rates go down. And so the question is, what next and what's the strategy? Clearly, just continuing to sit comfortably in a money market is not going to cut it in a low interest rate environment. So those are the kinds of things that you've got to really be thinking about, and how they then interrelate with your longevity, particularly some of the things that this AARP article was pointing about some of the ways in which you fail or people fail at retirement. Another one was really kind of considering how you're going to spend your free time, right? You can't take a trip every week because then you're going to start to get bored. If every day is Saturday, then it gets kind of monotonous. Rob and Kristen, in their show a couple of weeks ago, actually discussed and had a great suggestion in the form of kind of doing a 2-week trial run of retirement. So that might be something to think about. Another point that the article points out is make sure you talk this through with your spouse. You'd be shocked at how many times people come in and haven't really talked it through. And so we would encourage you to, before you come in and talk to me about retirement, talk to your spouse. Because if you don't, then it's going to lead to some awkward conversations that we've certainly seen over the years. Anyway, we'll have some more thoughts on this when we continue after the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Yeah, you might not believe what I was just saying in that prior segment there at the end as we were talking through these top 10 ways to fail at retirement, courtesy of an AARP article written by Bruce Horowitz. If you're interested in reading the whole article, we've posted it on our various social channels out there. It's got some great things to really think about to make sure that you don't fall prey to these mistakes and impact your physical, your emotional, your mental, your financial well-being. And make sure you talk to your spouse. That was one of them on the list that I thought was, I've seen that play out where you come to the office and people haven't really talked. That can lead to some awkward moments. So we highly encourage before you come in and talk to me about planning for your retirement, make sure you talk to your partner too as well. Along those same lines, be prepared for some social changes. The reality is that all your friends aren't going to retire on the same day that you retire. So you can't be calling them and saying, hey, let's go out golfing if, they got to go to work. So just be aware of those social changes that might happen. And of course, your friends from work, you actually may wind up missing them if you don't see them every day. Certainly the common ground and the shared focus obviously helps to develop those relationships. And so if you're not working anymore, then you no longer have that common ground. So you're going to need to kind of fill the time and perhaps maybe be proactive and start now while still working to expand your circle, developing new hobbies, interests, friends, all of those kinds of things. Another thing that the article points out, make sure that you are prepared for healthy aging. I guess that probably makes sense. You don't want to age being sickly. So the reality is that that's always the fun stuff when you hear people talk about healthy aging, right? Eating better, exercising more, drinking less, all that good stuff. But I guess there is some, validity to that. So if you're going to stick around, you probably want to be as healthy as possible. So anyway, again, to check out the full highlights of the article, check out our socials. If you have any trouble finding our socials, go to our website at nelsonfinancialplanning.com. While you're there, if you're interested in making scheduling a conversation about how you can avoid some of the pitfalls that people typically can fall into at retirement, then just fill out the Contact Us form, and we'll immediately get right back to you to schedule an absolutely free conversation with myself or one of the various certified financial fiduciaries at Nelson Financial Planning. Speaking of changes, obviously we talked a lot about the big, beautiful bill, a volume of 900 pages. But in terms of substance, and I guess here's really the key takeaway, not a lot of substantive change. This really just continues kind of the tax environment that you've been under for the past 6 or 7 years. Had it not passed, there would have been major changes that would have potentially created a significant economic drag because tax rates would have jumped up pretty dramatically. So this just kind of keeps the status quo. So perhaps the economic impact of this might be perhaps a little bit more muted, since its focus really was to keep intact The biggest of which was the income tax rates, to be able to make sure to make them quote unquote permanent, or as permanent as any type of tax policy legislation can be in Washington. The standard deduction, and this one also a much higher level, approaching $16,000 for a single person, $32,000 for a married couple this year. The point of that was to help simplify taxes in terms of, if you look back into the original legislative history, the goal there was to simplify taxes. And it's certainly done that in the sense that you don't have to sit down and kind of total up a whole bunch of stuff to see, okay, great, the total of all of this stuff is more than the standard deduction, because the standard deduction back then was relatively low. So I'm going to itemize now, because the standard deduction is so high. Very few people, less than 10%, find that it is at all beneficial to kind of go through that process. So higher standard deduction is now permanent. And with that higher standard deduction, there was the elimination of personal exemptions. So that's gone, along with a variety of miscellaneous itemized deductions. Again, all of that gone. In terms of estate taxes, it did address that. It shifted it, rather than having that drop all the way down to $7 million from $14 million, which would have happened had this bill not passed. Then it actually sets it so that it's $15 million next year, and then it's automatically adjusted for inflation after that. The higher child tax credit went from $2,000, or I guess it's permanently at $2,000. Used to be $1,000, and that one tweaked up a little bit to become $2,200 as the base amount for 2025, to be adjusted for inflation going forward. So obviously a lot in it, but a lot of it really did sort of continue on what was currently out there. So don't expect to get some big giant refund on your taxes because of all this change, because at the end of the day, it really wasn't a lot of change. It was just sort of making sure that the current tax environment could in fact continue after the end of the year. Now, there were certainly some headline changes, and the rules and the details and the specificity of these really lends itself to a whole separate radio program. So that's next week's program, where Christina and Zach will be really getting into these details of these specific items. Things like being able to deduct your state and local property taxes, that SALT deduction, some key changes in terms of how you're going to be able to deduct charitable contributions. So that'll be interesting. A higher standard deduction as it relates to folks over age 65. Nothing to do with the taxation of Social Security, but meant to help offset some of the tax impact that you would have when you are collecting Social Security. The other headline stuff, right? No tax on tips, no tax on overtime, writing off car loan interest. There's a lot of fine print on them. The fine print on them is extensive, and the limitations of them are extensive. So it really does lend itself to a whole nother program, which obviously Christina and Zach are going to do that next week. And then, beware of those interest rates. I guess the big data that came out just this past week was the inflation rate, showing an uptick up to 2.7 over May's 2.4. Widely expected was that increase, but you have to start to ask yourself, okay, well, if inflation is clicking up, doesn't that mean that the Federal Reserve might be looking to click its rates down? And the answer is, yeah, they probably are. And that's fine. That's good. That's obviously what the current administration wants. But for those of you, and there's a lot, somewhere north of $7-8 trillion that's sitting in cash money market, you're going to have to figure that out. You're going to have to recognize that your money market and high yield savings rates that were pushing close to 5%, and in some cases were above 5%, they're not there anymore. They've already dropped down in most cases to be below 4%. You get another couple of interest rate cuts, guess what? It's going to be in the twos. If you're in the twos, you're barely staying ahead of inflation. So that means that you really do need to start to game plan. And we found ourselves doing this with a couple of different folks just this past week, really starting to game plan. Okay, if my yield gets back down on this cash to 2.5 or whatever it might wind up, and that could be as early as the end of the year, then what else do I need to be doing in terms of my investment strategy? And so we would kind of leave you with that thought here on this week's program. The reality is that when we think about where interest rates are, with the expectation that they may be going down once or twice between now and the end of the year, the direct impact that is going to have is going to be on your cash, particularly if you're sitting in a money market or high yield savings account. So you might want to start to think about a plan for that. Those are the types of conversations that we have every single day at the office. So we encourage you to visit our website at nelsonfinancialplanning.com and schedule that absolutely free conversation. We always do that at no charge because really our purpose is to help you wherever you might be on your financial journey. That's why we also don't have any account minimums or stuff like that. So just visit our website at Nelson Financial Planning. If you happen to be in a beautiful Winter Park area, feel free to stop by the office. We're actually continuing on our school drive, our school supply drive, as we do each and every year. So you can drop off some school supplies to benefit Orange and Seminole County for that. With that, we're going to wrap it on up and get on out of here. This is Joel Garris of Nelson Financial Planning. You've been listening to Dollars and Cents.